Let's break it down for a couple of people listening from a property point of view. Okay, let's start with, I'm a first home buyer, I'm looking to buy a property. Has there been any advantage to me?
Not really. No, you haven't got any more money to do it with.
Yeah.
But what you're told, and this is again, it is unsound advice or opportunity. You're told that you will get negative gearing if you buy a brand new property.
Until you sell it.
Until you sell it. And then you're going to get taxed at 47% at the highest marginal rate, depending on indexation, when you used to be taxed at 23. By the way, let's be really clear on that. That makes Australia the highest taxed capital gain country in the world. 23%, what we were, is not that different to the US, not that different to Europe, it's not that different to any other first world economy.
Welcome all. Welcome to the Solid Ground podcast. Today we're bringing a special edition and we're talking about the budget in how it relates to property specifically. So we're lucky enough to have Anthony Bell today from Bell Partners, which are accountants and financial advisors. Anthony's going to break down his take on the budget, what you might want to consider when you're looking at your future investments, and is there anything you need to consider before the end of the 2027 year? Welcome to the show, Anthony.
Thanks
for being here.
No, thank you.
Actually, I'm in your office, so actually maybe you could thank me for being. I don't know.
Well, like I said, mate, we set up a podcast room now, so
great.
mate, you can use it any time you want.
It's very nice. So the budget, and I know you've been talking to a lot of people on this, and you know when I look at it, seeing from the outside, for me, it looks like it's just one big tax grab, and they're trying to sell it to us like we're going to fix the housing inequality, which sounds like rubbish. And they're all sort of, when I listen to it, it's like they're turning younger generations against the older generations. So that's not good. But what's your take on it?
Look, budgets have been handed down now for 30 years of my career. It's actually a big thing for accountants and advisors to be watching them. But this one's been the biggest one, Pete, out of everyone. If you go to Channel 9, actually ran the budget reading at prime time TV, where you usually see Married at First Sight. Yeah. And it was one of their highest rating shows they've had for ages. So everybody was tuning in because the stakes are so high. Look, the biggest thing in budgets is usually winners and losers. And most commentators, including myself, we're really struggling right now to find who the winners are in this budget. The losers are obviously investors. The losers are the property market in Australia, which has been underpinned for 40 or 50 years of generational wealth creation by taking risk, taking on a big bank loan. It's scary when you're buying your first property, being availed to interest rate fluctuation, losing a tenant, and you go through all these things, but you hang in there because you believe in the Australian dream of property market doubling itself every 10 years, which it has done since the 60s. And you then come out the other side. And if you're 65 or 70 years old, you've actually helped the country because you don't qualify for the pension because you've provided for your own retirement.
We were talking about it earlier. We were talking about, me and Ben were chatting here, a lot of people that might own their own home, and not everyone does, unfortunately, they don't have any other income. They don't qualify for the pension, and they are struggling.
And really struggling right now. And so, you know, we've got enough going on in the Australian economy. We've obviously got highest inflation we've had for consecutive periods that is not under control. I don't think anyone saw the war in the Middle East happening in that early part of March, but seeing that the damage done to higher cost of living at the gas station, and it's not just filling the car up, the extra $60 or $70 per week out of a family budget, which is $3,000 a year. That's a lot. Yeah. It's not that. It's when they're eventually going to go for groceries and have to pay, because everything we're learning now has diesel, fuel, or oil in it. Everything at Woolworths on their shelves has some form of transport in it, let alone the stuff that's larger, that has, you know, large headers and Massey Ferguson, ploughs and Rangers, transporting or moving stock around countries, all has diesel in it. So eventually those prices have to pass on, which is increasing, obviously, the cost of living. So enter the budget, and this information has been really clear for the last 2 months. And the guys talk about down in Canberra that this was a really responsible budget. I'm reminded when I first started my career, when interest rates were 19%, and the great Paul Keating using those words.
I think I started business that year.
The recession that we had to have. Yeah. And so this is now the responsible budget that we had to have. And we've got new buzz terms like intergenerational equality, which is like...
I wonder how many of them sat around to come up with that.
Yeah, but people listen to it and go, what an articulate terminology. That means absolutely nothing in the space of this, because the rob from the rich and give to the poor has been historic. Do you know what I mean? No matter what government's in power or support it. But the issues that come here and the ones that are critical, I really don't feel that the current government that put this budget out looked 15 or 20 minutes into the future of the knock-on effects that they're going to portray from delivering such a harsh budget. Now, the issue is we've got a massive government deficit. We're up to over $1 trillion, and they've got to try and fund that. So they've got to try and tax other parts of the community to try and wrestle that python
Heaven
back
forbid
in.
they cut back on some of their spending.
Well, that's right, and you wouldn't imagine that because, as I said, that even government employees in the last since the Labor government's come into power, I remember watching, staying up on budget night to watch the final speeches, and I remember Albo hopping in and saying, "This is a vote for the Labor Party, and this is for the workers and the unions who support them." And I remember feeling, wow, I wonder when we're going to feel the heat for that statement. And an unemployment rate of 4.1 or 4.2% is, far too low given how we're performing as a country. I mean, this may surprise you, but a great fun fact that's come out of this, in the 1990s, Australia was the most productive population in the world. And that's simply GDP, the gross domestic product we put up, goods and services that we put out to the world and manufacture and exports and sell services and sell real estate, divided by available workforce. We were the highest in the first world OECD market, better than America. We were better than China. We were better than the European countries. We were workers. We went to bed late from work and we started early. And now, 26 odd years later, it's astonishing to believe we are now the worst in the OECD, the 37 countries that make the OECD. It's a race to the bottom for spot number 36 and 37 between Australia and Mexico. So we're not producing much out there.
And isn't that like, I look at it being an old bugger and I go, what has the budget done to help with innovation, to encourage small business to employ more jobs? Instead, as you know, they tax us more if we employ more people, they pay payroll tax. There's nothing there to inspire innovation to come into Australia from a tax point of view. And the budget, I don't see how it helps first home buyers at all, because they're going to be competing now with, if investors move to new stock only, there's going to be more competition in new stock, which is where a lot of the first home buyers end up going.
You are bang on, Pete. I mean, look, try and imagine if it was going to do something to help first home owners, okay, they would have to stimulate and give those first home buyers, owners or future owners, a tax break to buy, a incentive to save. Now, all they've tried to do is go attack the existing investment property market and say we'll take negative gearing off, which, by the way, they tried it in 1985 and they had to repeal it 2 years later. So it didn't work back then in a Labor government in the 80s. They took negative gearing off then. 2 years later, they stalled the whole Australian psychic and entrepreneurism, so they took that off. New Zealand tried it in 2021, repealed in 2023. It just doesn't work. So this isn't a see how you go and let's try this to see what happens. History has shown that this doesn't work. But the biggest issue that comes for the first home buyer is pricing isn't going to come down anywhere near as much they hope to make existing investment property.
No. I think
more
I saw
affordable.
some estimates. The numbers that they had was like, it might be $19,000. Now, what is that?
$19,000 though, on an average. We're heading towards $1 million. We're already at 1.2 in Sydney. $19,000 won't get you anywhere. The banks are so hard to actually get a loan of. So I was looking for, if they're going to do that and make housing affordable, there had to be a program to achieve that. But there's nothing in the budget for that. What it really is a wrestle in of what's become over government spending, more debt that these poor generations, these 20 and 30-year-olds are going to inherit long after we're gone, Pete. They'll be paying for this budget deficit. And to try and pay back the loan that we've actually got in deficit and try and return a surplus, God willing. But the $250 per head for $13.3 million, that'll be in Nikes and Puma shoes and it'll be gone. Yeah. Which, by the way, will cause another form of inflation.
So let's break it down for a couple who are listening from a property point of view. Okay, let's start with, I'm a first home buyer. I'm looking to buy a property. Is it been any advantage to me?
Not really. No, you haven't got any more money to do it with. Yeah. But what you're told, and this is again, it is unsound advice or opportunity. You're told that you will get negative gearing if you buy a brand new property.
Until you sell it.
Until you sell it. And then you're going to get taxed at 47% at the highest marginal rate, depending on indexation, when you used to be taxed at 23. By the way, let's be really clear on that. That makes Australia the highest taxed capital gain country in the world. 23%, what we were, is not that different to the US, not that different to Europe, it's not that different to any other first world economy, but we've just effectively
So they're saying a
doubled it.
minimum of 30% tax, or more or less.
Yep.
But of course, they're basing it on the year and what else you're earning. So you sell your property, just say you made 500 grand on it after 10 years.
Yep.
Then you could be into that 45 cents in the dollar tax
Correct.
rate.
But then again, Pete, show me an investment, a brand new investment property that's not 1.3 or 1.8 million dollars. I mean, it's got the most expensive building materials, cost of labour, cost of, they said, we talked about the fuel levies before, building prices are going up. So these guys that aren't, and girls who aren't going to afford to buy property now have the only incentive plan where negative gearing can come in, where they might even have to stay at home and live in their bedroom that they've lived at since they were 4 years old till they're 32, to get a tenant in. But the size of the acquisition is going to be well over the $1 million mark. And those people can't get it. The banks aren't giving it. We're 4 to 6 times ratio. Average salaries in Australia, do you mean sort of still inside 100,000? That gives a $400,000 loan to an applicant.
And part of the thing is, right, is there's lots of talk about it. There's not enough stock being built. And of course, part of that issue too is the stock that is being built may not be where most people want to live, because it could be away from their family and right out west, so I understand that. But anyone that owns a property, whether you are 20 or 60, you don't want your property to go down, because that's where most of our wealth in Australia is accumulated.
Absolutely.
So you've got that, and it's not going to go down. I mean, unless we have no population growth, which is not going to happen. And, you know, we should be having people come in and move into Australia. I think it's good bringing skilled workers. It's good. And obviously there's babies. So we're going to have growth. And people want to aspire to always buy a better property. So let's talk about existing homeowners. Can't see any benefits for them. But just say they own a home. Is there any impact for them?
Well, the only existing benefit that they've got is they didn't touch primary place of residence exemption. So it's the last untaxed asset in the world. So what will people do who would call it their sort of, you know, in their mid-40s to 55, somewhere in there, they've got a young family or a growing up family, they've bought a couple of investment properties to, you know, eventually, you know, make money while they sleep, and they're in a primary place of residence. Those people will start thinking, you know what, I'm going to divest myself out of the new property game, and I'm going to sell up and I'm going to put my money back in my primary place of residence, where at least I'm capital gains tax free. Yeah. Now, that is usually the Australian dream and what's set there. But let me say another thing too that they didn't consider here. They will make this dream of young Australians making property accessible because rents are going to go through the roof.
Correct.
Okay? If you buy an investment property after 7:30 on Tuesday night, you suddenly have not got the gearing against it. So you're going to ask for that money back from tenants. And you know what? With our economy going where it is and our immigration rate so high, you'll get it. Oh, and then the next side of it
so it's not like there's an oversupply of property, and there's not going to be. We're going to have an undersupply.
Undersupply. So that's going to push rents up even further than what they are now. So again, if you come back to being that person who's just trying to, you know, about to get married, buy a 2-bedroom unit, your alternative is to stay at home with mum and dad till you're about 70 years old, and to buy a place and let, you know, the rents pay off. Yeah. But you will get no break unless it's a brand new property on interest. And then I go a step further. The family house, yeah, there's house and land packages going everywhere, but that'll work for. But this is a long way away before people get to live in the sort of standards that they want to.
So investors. I'm an investor with 1 or 2 properties, and I think their stats are, and I haven't looked them up recently, but I think it's like the average investor owns 1.5 properties or something in Australia. It's not all these rubbish that they talk about. Yes, there's some people out there that own 50 and a lot of properties, but it's a small percentage.
That's right.
So what do investors do? They sit on the side and watch. How would they, obviously got to speak to their financial advisors, their accountants particularly, and go, how do I look at this? And my saying is, always speak to someone that owns property and understands it if they're an accountant.
Yep, yeah, very
Not
true.
just reading the numbers.
No, very true.
So what, and it's hard because everyone's situation is different, but what should they be considered? What do they need to know? They may have missed the budget the other night because they're raising their family. What are the key things that's going to impact them now?
Well, the first thing they're going to do is they've had that standard 1.5, 2, 3 properties, whatever, and they've got a primary residence. They're going to be seriously thinking about selling the negative gear property that they've got that's grandfathered, or grandpersoned, as I heard this morning, but grandfathered in the old language. They're going to think about selling it, Pete, and I'll tell you why. they're not going to hold into periods where they're going to pay 47% tax on it, because the equity that they've fought for and boxed through for sometimes 10 or 12 or 15 years, that equity will diminish by taxation. So their thinking will be, sell the grandfathered property that I've had, take the equity out of that and jam it into the family home that I'm in, because the mortgage is growing with interest rate rises and inflation as well. And if 7 and 7.5% starts hanging around, that makes it unaffordable. So what will happen is that intergenerational wealth bubble that we talk about, which is like this non-existent story from generation to generation, will be thinking now about offloading, okay, and jamming up the family home and getting the loan on the family home as low as possible before higher taxes come on. And then they might start thinking, going, right, now that they come back into the cycle, I will look at new property, okay? Pricing is going to be not accelerating for some time as a result of this. It'll be quite stagnant, because we'll have purchasers who are incredibly paralysed of, I don't know what to do here. But that's also too, in these sorts of situations, an old statement from one of my mentors, never let a good crisis go to waste. The high net worths in our client base here are talking about where opportunities lie, and they will try and buy great property, whether it is brand new property for the gearing, but some of them will just say, well, we're not even using gearing, we're just buying with cash because it's a good incentive.
Yeah, because they may not have debt.
That's right, they haven't got any debt. And so we've got to keep that in mind for it. So, but
question on that though. So they have grandfathered some of this from an interest point of view. So can you explain that to people listening today? What does that mean, and how obviously that's going to affect when they sell it again, because then the next person won't get that negative gearing anymore. But just talk through that.
So those people that have got it will probably do one or two things. I said they'll either go, look, I'm the last of the V8 supercars and I'm going to keep my fully negative geared property and my grandfathered capital gains tax entitlements, do you know what I mean, sort of into the future, but I'm not buying any more. Okay, I'm not buying.
So the
anymore.
Negative gearing stops for them as well.
It stops for them as well. If they
when
buy
does
again,
that stop?
That stopped at 7:30. If the budget is accepted,
just for people listening, so that the capital gains are still on the old regime.
That's
if
right.
they bought it prior, but negative gearing, is that going to change for them?
Capital gains is shifting to the indexed model, regardless of anything. So that's taking place. So, but the negative gearing is quarantined and protected into the future for the next 10, 20, 30 years. But if they sell the property and start again and do exactly what they've done for the last 20 or 30 years to acquire wealth, they won't get negative gearing. So try and imagine, investor A says, I'm about to buy $1 million property, okay? Rents will be high, so I can expect to get probably $50,000 worth of rent. In the old days, I'd borrow $800,000, call it, sort of 7% if it gets that high, okay? So they go, oh, great, that's $56,000 coming in. It's $56,000 going out in rent. It's 50 grand coming in. I made a loss, and the tax office will let me negatively gear that, and I'll halve the loss. And the whole property is going to cost me like $3 grand. That's a buy, because it doesn't diminish too much of your income. But now under the new rules, you buy an existing property, you'll get the $50,000 worth of rent in. You'll get no tax deduction for the cost of interest. So you'll get a tax bill of $25,000 at 47% of rent. And for a person making 120 grand a year, they're going to go, I can't afford to have this house.
And isn't there something that, what's that period where it was before 1988 or something? That's
1985
sort of deal.
So, but that's an interesting point. I'm glad you brought it up, Pete. 19th of September 1985 was a date that capital gains tax came in. And like this, they said that anyone who's bought a property in Australia, investment, business, anything, shares, stocks, if you bought Westfield's shares when it first listed in 1960 and you sell them today, if it was bought before 1985, is no capital gains tax. No. So those groups are all people around 70 years old, 70 or 80 years old. You will see a lot of stock in property market come onto the market, because that is going to actually need a valuation done in 12 months' time to protect it. So that's back on the market, that well-covered asset that is tax-free.
So it's still tax-free if they sell it?
Pre-85 is for the next year.
Only for the next year?
Yeah, after we get to the next year, you have to get a valuation done, and then you're taxed on everything that takes place after the valuation.
Point. So they're not technically getting it tax-free anymore. They're just saying from next year.
That's right.
There's tax on the growth from that year on.
But you can imagine what's going to happen. They're going to that owner's going to go, you know what, I'm selling now. Yeah. It'll be good for real estate agents because they'll be moving stock. And that person will go, I was going to keep this and hand it down to my children because it's capital gains tax free. Now that that's stopped, I may as well cash out, because what do all self-funded retirees want? They want liquidity. They don't actually want houses that they can't put a credit card in and pull cash out of. So that will bring the 70s to 80s to even 85-year-olds who still own pre-85 held assets that are tax-free. They're going to take that tax freedom over the next 12 months and look to move that property.
You know what? It's really disheartening that, one is, besides they said that we're not going to change negative gearing and they just lie through their teeth, but, unfortunately some governments do that.
It's a policy change. It's a change in policy. It's not a lie. It's just a change in policy.
It reminds me of saying like this recession we had to have. Did someone say that once?
Yeah, 992, Paul Keating.
Yeah, I remember that because I had a restaurant then. I was in the restaurant business, and that was hell.
Or you would have remembered
we went from people out every day for lunch to no one.
No one. And you would have remembered 18.5% interest rates just to get by. So no one could get ahead in that era.
I know. It was like people don't understand how high interest rates can go.
No, but likewise.
So I think the 18, but I remember I had some money lucky enough in the bank at a successful restaurant in AGC shares. I think I was getting 18%, but the actual headline rate they were charging was 23% interest.
Unbelievable. I mean, that is when it wasn't over a mortgage, but it was business finance, right? Yeah. But I can go back into, because history's told us that the Labor government of 1985, which was the Hawke government, they actually did exactly the same thing that these guys have done today and abolished negative gearing, which is, by the way, part of the Tax Act, 1936 Act, Section 51(1).
Yeah.
It's a cost of business. Interest is a cost deductible. But they abolished it in 1985. Only 2 years later, they brought it back in. They unabolished it.
It's going to be interesting how it changes in another couple of years. Obviously, they couldn't roll this out next year because it'll be a year out from the election. They want to try to push it through. Let's hope that whoever becomes the opposition, that can go against this and rechange it. But
all forms of opposition, whether it be the Liberal Party, like I said, obviously there's a new force in Australian politics called One Nation, and they've all come out, every party, the Nationals as well, and said if they are elected into government next time, they will repeal all of these ridiculous changes.
It doesn't make any sense to me. I mean, except that it's a tax grab and they're trying to reduce it.
They've got to pay the debt, and that's what it is. But giving everyone back $250, say this is your benefit. It's $5 a coffee. It's one coffee a week. It won't go far for the generation. Why bothers?
I know, it's horrific. So look, on a couple of things. So let's maybe quickly talk about trusts.
Great.
Because probably some of our investors listening have got property owned through trusts and so on.
Yep.
How's it different than the current structure? Is there any advice you'd give them to consider at this stage and so on?
This is a big problem as well. I mean, I'm glad that we brought it up, Pete, because we talked negative gearing and we've talked about capital gains tax. The trust distribution tax is a whopper. It's a whopper for everybody who's a business employer. We have 1 million business employers. We have 18 million people working as staff members in Australia, and 2.3 million of those are public servants. So to that person who has got ahead by using family trusts, making distributions and getting the tax breaks, they've grown their businesses, they've employed people based on it, they've taken on debt and machinery and bought premises on that basis. Now get told that it is a standard 30% tax on any distribution from a discretionary trust. And that is painful because some people have losses in other entities that they're entitled to access. And under the new proposal,
so they've got to pay it at the trust level first.
They have to pay at the trust level first, which means those losses will be quarantined. If they bought the property in which they trade in, if they're a real estate agency and bought the building and they're paying rent to themselves and they make a loss on depreciation and on interest, accessing those losses will now become impossible, which will put the whole business, sort of into stride.
It's going to affect employment. And then
massive.
Thinking of this because, most small businesses. Even the business I run is a small business. Yes, we are a big network, but we're still a small business.
Yep.
And part of that, they're all individual business. I know it will affect people. And it's certainly going to affect people's decisions to make around employment. Do I want to I've got to save money here now because it's going to cost me more to run my business.
Margins,
I can't put on that person.
And I can't put that person on. So what are my alternatives? I'll go offshore for a cheaper alternative.
Yeah.
Or I will now bring forward that funny word that's been going around for 3 or 4 years, AI, and I'll start to get into automation and robotics because they simply need their margins back. So small, medium enterprise Australia is not doing that well. It hasn't been doing well for some time now. Rising interest rates, difficult employment costs, and again, governed by our unemployment rate. And so I'm all for it. We employ about 250 people in this organisation. They're good people. Lots have been with us for a long period of time. But I would say that the biggest pressure on is to the employer is that margin which keeps on closing and closing and closing. That if it's a choice between insolvency and survival or laying off staff, which are the fastest in the first place, they'll choose the second option and finding alternatives for cheaper staff because it's not like small, medium enterprise right now is singing from the hilltops or cheering from the roof about how great this economy is. They've been struggling, and we've been struggling for some time, and the cash flow cycle is getting worse. Our bankers, through APRA regulation, told now only up to 4 times income you can loan. Guys need 7 or 8 times, but they can't get it from the banks. Yeah. So this is the big risk in our economy, is that, yes, it's important to look after all employees, and I love a low rate of unemployment, but if employers start going broke everywhere, the government won't be able to create enough jobs.
It's already been increasing, like when the interest rate goes up, it makes it hard for people with debt, and it makes it harder. And then they've got to go, well, I'm either going to lose my house, or do I need to cut off a wage or 2 in my business? Well, we know what's going to happen, as you just said.
Pick the wage.
So that's already happening, and then they bring in this budget, which is only exacerbate what's going on, which is. I'm just dumbfounded by what they've done.
Yeah, and the general thing I say to, when I go and speak to companies and young people say, well, how do I survive this? I say, be the hardest worker in your place. Yeah. Okay, be the person who produces most for their employer. There will always be jobs for people who are helping produce, rather than simply being part of the cost mechanism. But that's the pressure the government's
Don't turn up
on.
And say, like, how many biscuits are in the tea room, and
that's
do
right.
I get 3 days at home working?
Yeah, or I like to go surfing on Friday afternoons and have Pilates on Tuesday, right? That's that is, and I know that this work from home thing is there, but I'd hate to have the non-foresight to say that if unemployment starts to rise, there'll be those that say, geez, I wish I worked harder in my job because the company survived, but 20% of the employees didn't, and I don't want to be in the 20%.
I think it has to, like you think with what's happening, and business is going to look at this and be taken on pretty quickly, and it was already a tough market, particularly in real estate market. It's been slower over the year. There's more transactions in some way happening, but it's been slower. So employment's got to rise. That's how I see it. But I remember when I started work, this was in 1980, 79, the unemployment then was 11%.
That's right.
10.5%.
And if you're an employer, I can still remember I was working for my dad in 1989, and Dad was a tough taskmaster, and he'd literally fire somebody who didn't get a balance sheet to balance.
Wow.
And he'd fire them on a Friday. Yeah, and he would, that's right. I suppose you're in the accounting profession. But it was funny, the amount of times Dad would say to me on a Friday afternoon, this is in the 90s, okay, I've fired Tom or I've fired Mark. Put an ad in the Sydney Morning Herald tomorrow and get me a new chartered accountant. I'd place the ad. It would be out in the Sydney Morning Herald, and there would be 40 resumes of fully qualified people, not recruiters led, just people lining up looking for a job. And we will have re-employed that job within hours. Now, that was because we were in a recession and things were difficult. I don't want to see it go back to that, Peter.
I think most businesses don't, and this is again as we keep saying, it's just, and as you said, all the opposition, all the different parties have all come out and said, what is going on? Anyway, let's go to something interesting.
Okay.
Besides sailing, which we should talk about that.
Okay.
Aren't you going to go into sailing again this year?
The rumours going around, and we'll do our best to try and push it to the side and not comment on it yet.
All right. Well, let me know, because maybe we can break the story.
The word is that we're back anyway.
Oh, that'd be good. So
it might be the first time the rumours and the gossips are actually correct.
I've watched your career in sailing and your wins with being a sailor myself, so I quite enjoy that, watching that. So that'll be exciting. One thing we mentioned, tell us about your first property experience.
Okay. I can still recall it. I was living at home with Mum. I was 25 years old, and Mum was a big person. She was always about forced savings, and I was on a salary, Pete, of $50,000 per year, and I bought a property, and I used the equity in Mum's house, so I had a 100% loan for a $369,000 purchase.
Wow, that's a big debt then.
Yeah, and I couldn't afford it. But what I did do was I stayed at home. I let the tenant come in. I had negative gearing. It incepted me into it. And then that property was a 2-bedroom unit with a garage and 2 bathrooms. And that property put me into the next property when I sold that and rolled that one over and kept on rolling it over. But the thing I want to bring up is interest rates when I first bought it. I was in the mid-90s. They were like 8, I'm going to say it was 10.5%. Wow. They were on the way down, but hadn't got down to lower rates. But it was still a great story for me. Now, the difference is that I didn't have Uber Eats delivering me lunch every day. I didn't have an expensive lifestyle. My whole sole focus coming out of Maroubra with Mum.
We lived a lot cheaply.
I had to live cheap because
there wasn't all the entertainment. We weren't invited by our friends to come down to this cafe, spend $50, $60.
We were $20 out. Do you know what I mean? Sort of a couple of beers on a Saturday night, and because that's all we had. We would have spent more if we had it. and woke up with bigger hangovers the next day. But the fact of the matter was that drilling, and it was just simply, it was Y versus X. But that property I put back to it got me going. And it was difficult, but I governed my life by just getting into that market. So it's about sacrifice. And, sort of then I just kept on following the same suit. And this is why I'm so, I want the young people to get a shot at negative gearing, because I would never have made it if last night's rules, or sorry, the budget rules came out and took negative gearing off.
It could have been something, even if they were to look at, there was talk around, would they limit the amount of properties you can negative gear?
Yeah,
even that could be a thing, but it allows people to build. They talk about us trying to create more wealth, so in our retirement to take the pressure off the system.
Yeah.
Now they're taking that away, so it doesn't make sense. But they could have said, well, we'll limit you to 3 or 5 properties. They
could have, and they're probably thinking this through with that. But I think they've had this massive debt hanging over their head, over $1 trillion. They go, we need to create a surplus to actually start paying the debt down, because we're choking ourselves out. So the biggest issue that the government's got right now is they've got them into this by over-government spending. And unfortunately, they're punishing every Australian and the aspirations of Australians. This is a part, like the imagination, aspirations of guys going, we can just tough it out and get ahead, because we get a couple of breaks here. And I've got to tell you, it's worked pretty well for the last 30 or 40 years, negative gearing. Okay, everyone is not in bad nick because of it. So to take that off and do capital gains tax and then tax trust, it's a lot at once.
It's something we understand in property, I think, is in Australia, that we will go and take on the debt because we know we'll rent the property out, we'll can negative gear it, we can offset it. Yes, we can't maybe have an expensive lifestyle as well, but it's a way of forced savings to get ahead, which is I bought property, was like, if I had to pay the interest amount or the capital reduction on it, I wasn't spending that money.
That's right.
And so I always loved property and debt for that reason, because it forced me to save.
And you felt good about it too, because you go, you know what, things are a bit tough, and I'm in the early days in your 20s, you're taking a girl out on a date and just getting a pizza and a Coke and that's it. But you at least go, but I'm setting myself, I feel growth is taking place. You read the local magazines that talk about property sales in the block, and you actually go, I'm making money while I sleep. And that is what Australia's been built on.
So what might be good today, and thanks for your time, Anthony.
Of course.
Would be good get your little cheat sheet, and we'll put it at the end of today's video, and just outlining some of the key things around when dates change, how the negative gearing's changed, so people can read that, because I know we've chatted about, maybe not everyone's picked up all the nuances of what we've said. Great. So I think we'll run that in there. But look, thanks again, because it's having your time. I know you've been pulled from pillar to post.
It's okay for you, anything for you, Pete. And I will say this, a hot tip is, we're going to hear tonight at 7:30 the opposition's reply to the budget, and I think it's going to fall on deaf ears. This is heading to legislature. This is going to get stamped, and this will become
they just
law.
Don't have the votes for
they're not afraid of their opposition right now, so they're not afraid of losing.
I think there might
momentum.
be in 12 months.
Yeah, it could be.
Let's hope our oppositions step up and get the right policies. Anyway, thank you very much.
Thanks very much, Pete. Thanks.